Hello, economics students. We're very close to the end of this little revision series, which means you're very close to your exam, which is amazing news. We're looking at charts, graphs, data, and calculations for those 1 or 2 or 3 marks that you're going to get on an economics paper that you will not miss, that you will get, that you will not lose. So let's start by just looking at how we look at an index. So let's just remember what an index is. And indices we look at a lot in economics: CPI index, export price index, import price index, consumer sentiment index, and so on. There's too many. And so let's just remember that it would be very hard for Alan Kohler to get on the news at the end of the day and report on 100,000 changes to goods and services, or 100,000 changes to prices of goods and services. It would be very annoying, it would be very boring, and nobody would listen. So what the CPI does, or what an index does, is just bring complicated data sets down to one number. Okay, so rather than having 100,000 data points, we just get one number, which tells us what's going on. Remember that all those prices are weighted, and so it's very confusing. Much easier, much simpler, much easier to report on if you just get a number like 100. Okay, and then, of course, what we can do from there is we can say the index has increased by 5 index points from 100 to 105. Or, as we're going to do in a moment, we can quote the rate of growth in the index. Or, as you would know, given that your maths is better than mine, the index has increased by 5%. Okay, so you could quote it two ways. The index has increased by 5%, as they often do on the news. Inflation is up by 2%. Or if we're looking at the index has gone from 100 to 102. Okay, it's really important to know what you're looking at, because you don't want to make this mistake here. You don't want to say, Mr. Villain, when we're looking at CPI growth, so we're looking at growth in the index, to say that, well, this is deflation, okay, because it's not. It is a decrease in the rate of growth, all right? So inflation was running at about 2%, and then now it's running at about 1.5%, which just means that prices were growing by 2%. Now they're growing by 1.5%. Okay, so you have to know, and the trick is to look up on the y-axis and see, are we looking at the percentage change or just the index itself? Now, just to check and make sure that I'm not lying to you, if we looked at the underlying index, the CPI index, which of course is those 100 numbers rather than those percentage changes, then you can see that at no point has the index decreased until after January 2020, which looks like about COVID time, when yes, prices did decrease. And we can check, yes, prices did decrease because they went below 0 as a rate of growth. Don't make that mistake. Another one is students look at the growth in the wage price index, or wages growth, and they see the trend is decreasing down wherever you're looking. And they say, yeah, wages are decreasing. Wages are not decreasing, just the rate of growth is decreasing. Here's my very terrible attempt of drawing that. If we were looking at the underlying wages in this one here, so what were the actual dollar figures that on average that Australians were getting paid? Well, they're increasing, and then they're still increasing, just not by as much. So they're sort of flat line here. All right, describing movements in graphs, charts, data, whatever. Remember the time period. It's pretty much always 2 years, so you just want to trace the last 2 years back and make sure you're looking at that. Forget the rest of the RBA data. Unfortunately for you, the RBA mostly do their charts in like 20 years, so you need to ignore 18 years and look at the 2 years. Very easy. You should know this by now. Draw a line of best fit and just tell the assessor, is the trend upwards or downwards? You can add some flavor if you want. It's steep, it's flat. What you don't want to do is say that it goes up, then it goes down, then it goes up, then it goes down. No, the assessor will not like that. They will hate that, in fact. And of course, you don't want to make the mistake of thinking you're looking at the index when actually you're looking at the rate of growth, or vice versa. So you need to go back and make sure you know that. Here's a good example. So this was from 2 years ago on the 2019 paper, and we're looking at house price growth. Now, there's a couple of ways you can know that, because it says growth up the top here, year-ended growth. It also has percentage on the y-axis, and it also asks you to describe the trend in the growth of Australian house prices. So I would have thought this would be the easiest 2 marks on the whole economics paper. I could have pulled someone out of PE or biology, and they could have got this mark, or these marks. There's 2 of them. But that wasn't the case, and plenty of students lost a mark on this. Here's what they did. They said house prices have decreased because look, it's gone from 10 to -5. That's a decrease. Or they said it decreased by, or house prices decreased to -7%. None of which is true, because over the period, and sorry, I missed this slide, but we need to draw our last 2 years, draw our line of best fit. Just remember what's happening here. The rate of growth, prices were growing by 10% here. They were growing by 5% still, so they're still increasing. They were still increasing here. Only when they went below zero here did the prices actually go backwards. So you'd have sort of like a hump. Do we know that over the period the prices went up or down? No, we don't know that. Okay, so the simplest way to do it was just to say the rate of growth has decreased from 10% to -7%, roughly. Calculation. So there will definitely be, well, there's almost always one, maybe two, maybe three calculation multiple choice questions. In my time, there've always been multiple choice questions, so you never have to show your workings or any of that. A couple of things to remember. Usually we're calculating the index or inflation. We might use the index to calculate the rate of growth or the inflation rate. Sometimes GDP, very rarely. Balance of payments data, yes. Current account and CAFA. The terms of trade, and the budget outcome. We're going to do an example of each. A couple of things to remember. A quarter is from January to March. That's quarter one. Or March to June, that's quarter two. June to September, quarter three, and so on. An annual calculation is over a whole year. So from quarter one, January 2021 to quarter two, January 2022. Did that make sense? I hope it did. You get it. God, who wants to study economics? No, that's a trick question. You do. Annualized figure is when we take a quarterly figure and we times it by 4. Okay, so what was the rate of growth over January to March? If we annualize that, we times it by 4. We're projecting into the future. And finally, real inflation or real GDP growth is when you take out the impact of prices. Remember here that VCAR they're trying to test your understanding of economics, not maths, even though they do ask you to do some simple addition, division, and so on. Okay, so here's a common question. Something to do with CPI. You've got the index number, and like I said, you need to calculate the annual, so over 1 year, rate of inflation from year 2 to year 3. Okay, so the formula for calculating the rate of growth is always going to be the same. We take the data at the end of the period, and we minus it from the data at the start of the period, okay? And that gives us the difference in index points. Then we divide it by the start to turn it into the percentage and times it by 100. So what we're looking at here is that from year 2 to year 3, the CPI increased by 11 index points, didn't it? 121 minus 110. Then if we divide 11 into 110, well, we don't even need to know any maths to know that that is 10%. Okay, so A is our best answer here. I'm going to give you a moment to look at this one. So pause and have a go at this one. Okay, so what I was trying to say before is a year is from June 2017 to June 2018. That's a year, okay? So sometimes students say, oh, a year must be 4 quarters, so I must calculate from here, 110 to 120. But that's June to March, which is not correct, okay? So if you knew that a year is from June 2017 to June 2018, it's the same data, isn't it? 11 divided by 110 equals 10%. Okay, there it is, and make sure you know the annual rate. We've done this one before. Remember unemployment rates. We have to know how to calculate unemployment rates or classifications of the labour market. Could be participation rate. So in this case, remember that the unemployment rate is the amount of people who are unemployed in the labour force or as a percentage of the labour force. So first we know there are 10 million unemployed people. What are they as a percentage of the labour force? And the labour force is 70 plus 10. So we do 10 divided by 70 plus 10, or 10 divided by 8, which is 1/8. Now, you can work out how to find these. You have to sort of fumble upon the correct answer here. You may not be able to turn that into percentage, but you can work out which is the correct answer with a bit of fumbling. Finally, we've got a couple more. Balance of payments, pretty simple. We've got to add up all the sub-accounts to work out what happens on the current account, okay? So remember 110 minus 50 is 60 billion, minus 90 is negative 30 billion, plus 25 equals negative 5 billion, which means the current account is a $5 billion deficit. Just be careful. Sometimes they might ask you about the CAFA, which would just be the opposite. Because they balance out, it would have to be a $5 billion surplus. Sometimes in here, they try and confuse you. So make sure you're looking at it in net terms. Maybe they put the credits or the debits here and you've got to calculate a little bit more. Terms of trade. This is an example of a terms of trade question. You didn't need to calculate anything here. You just need to know what the terms of trade was. Remember, it's a ratio of export prices compared to import prices. And in this case, we've got a base here, 100 over 100, which equals 100 as the terms of trade. And we can see in year 2 that the export prices go down. We know that's bad for Australia. And import prices go up. We know that's bad for Australia. So straight away, we can say, must be the terms of trade is deteriorating. And finally, from last year's, this one was asking you to calculate the underlying cash outcome or cash surplus. And here you needed to know the difference between the headline budget figure, which was total receipts and total outlays, and the underlying budget figure or the underlying budget outcome, which is taking out the impacts from investments and future fund earnings. Okay, so what you needed to do was total receipts minus total outlays, which equals a $25 billion surplus. But some of this surplus money was from investing, so we have to take that away, which makes it take that away and take away the future fund earnings, which was from investment as well, which leaves us with a $10 billion underlying surplus, but it would be a $25 billion headline surplus. So be careful. All right, that's it for calculations. The very last, lucky last video will be on current economic data and some current policies, which of course you will want to see to make sure you can get them into your answers. See you then. Whoops.